Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Hello, everyone, and welcome back to Inside the Vault with SWP. Happy to have you with us as we dive into the world of precious metals and precious metals investing with some of the brightest minds in the space. I'm your host, Jeremy Barlow. If you've joined us before, thank you for your support. If you're a new listener, welcome to the show. You can always catch our previous episodes of Inside the Vault with SWP on our SWP YouTube channel, along with our video series of the same name hosted by SWP CEO Mark Yaxley. Inside the Vault is the most viewed channel about precious metals investing on the web, full of industry expertise and best practices for novice and expert metals investors alike. While you're there, please make sure to like and subscribe and hit that notification bell so you don't miss any of our content. We're incredibly excited to expand Inside the Vault into podcast form through ANCAP Radio. So thank you to ANCAP for hosting us. We have a great show lined up for you today. We have technical analyst Chris Vermeulen of the Technical Traders who will be with us shortly. But to set the stage for Chris, we have Mark Yaxley with his weekly market update. Mark, over to you.
Thanks, Jeremy, and very excited to have Chris with us. He's been providing quality content to SWP's followers for a number of years, and he's one of the very best technical analysts in the precious metal space. So everybody should certainly stick around for that. In terms of a market update, it was a challenging week for gold and silver as precious metals continued to trade on the defensive, Jeremy, influenced by adjusted interest rate cut expectations. U.S. economic data remains robust, and a higher for longer interest rate policy is now firmly back in play, exerting pressure basically on both gold and silver. The metals had initially priced in an interest rate cut in March and possibly 2 or 3 more cuts in 2024. However, the scenario of lower faster, which would have been positive for gold or silver, now appears to be in jeopardy. The U.S. stock markets and the U.S. dollar strengthened last week, while gold fell 1% and silver dropped by nearly 3%. Global inflation risks are on the rise. Inflation is back, or it's still here, due to surging shipping costs caused by events in the Red Sea related to the war in Gaza and severe drought conditions in Panama. Water levels in the Panama Canal have receded by a third, which is reducing the daily shipping cargo capacity through the channel. Coupled with uncertainties in Taiwan, one of the world's largest exporters of goods, inflation remains stubbornly persistent at the moment. The market's focus for the next 2 weeks is really going to be on monetary policy commentary coming from different central banks. The European Central Bank, the Bank of Japan, the Bank of Canada, and of course the Fed are all going to be speaking within the next 10 days. It is widely expected that interest rates will be held steady where they are during this round of meetings. But to end on a positive note, gold priced in Chinese currency surged by 17% in 2023. Gold demand in the world's second most populous nation was reported to be nonstop throughout the year and is expected to continue in 2024, providing upward support for the price of gold. Back to you, Jeremy.
Thank you for that, Mark. Lots to think about there, and I can't imagine anyone more prepared to help us unpack all this than today's guest. As I mentioned, Chris Vermeulen is a technical analyst, author, and the founder and chief market strategist of the Technical Traders, which is an independent tactical ETF investment newsletter aimed to help you achieve your financial and lifestyle goals. Chris is also, as Mark mentioned, a very close friend of SWP. Chris, welcome to the show.
Hey, thanks for having me, guys. Pleasure to be on the show, Mark and Jeremy.
All right, so before we kind of dig into things here, I always like to give our guests an opportunity to introduce themselves. I was looking through your bio on the Technical Traders website, and you do have a pretty fascinating background. So maybe if you can give us the quick kind of 50,000-foot overview of who you are and what led you to the chair that you're sitting in today.
All right, sure. Well, 50,000-foot view is I got involved in the stock markets in high school, got addicted to how easy money could be made, so I thought. And really, it became my passion and focus. And I traded through the tech bubble or through the tech top and trading fundamentals. and quickly learned that, you can buy companies that are growing by leaps and bounds using fundamental analysis and earnings, but the share price can still get cut in half and then get cut in half again during the tech bubble. And that was when I learned fundamentals and news don't really work that well when it comes to investing and protecting your capital. I switched gears. I went to technical analysis, which means I follow price. And all of us as investors, doesn't matter what you own, we all want the price to go up if you hold it. So I found if I just follow price, I can hold things going up, and I don't need to hold anything. I can dump it if it's going down, depending on what I want to do. So that's kind of in a nutshell what I focus on when it comes to the charts. I've been doing this for about 26 years, and precious metal space is one of my favorites. That and the stock market indexes, it's where I focus on most of my capital. And I use a strategy that really focuses on identifying long-term cycles. Like we've got a super cycle starting in precious metals, much like we saw back in 2001, and looking at major cycles in the stock market and the economy. And if you know what all those are doing, you can get a good gauge on where to put your money, what to expect to happen with your investments. And that is a huge part of investing, is having the mental game of knowing what's potentially going to happen and having a strategy in place to do that. And it really comes down to managing risk and your emotions, your expectations from the market.
The main thing the first thing I took away there is that you got into the stock market in high school, and that's got me feeling pretty down on myself, given that I was sleeping in and playing video games all throughout high school. If I had it to do over again, I definitely want to talk to you about this precious metals super cycle, and I think that'll be something of interest to our viewers. Before we get into that, let's talk a little bit more about the technical traders. What is your investment framework, your mindset, and your approach to trading? I know you kind of mentioned it a little bit there. How does that translate to your service at the technical traders?
Yeah, so pretty much everyone uses one or both of the typical strategies to invest their money when it comes to the stock market and their portfolio. The one main one is you either have an advisor and you're a passive investor. You pretty much do nothing, which is an extreme measure. Doing nothing is very extreme. The other side are active traders, people who are super aggressive and they're trading all the time. That is also extreme. If you do anything to the extreme, you can have some really good luck, but it can also backfire. And in the stock market, it's always just a matter of time before either the market does something you're not prepared for, or you break some trading rules, or your emotions get in the way and you lose it all. So I use a whole strategy, which I've kind of coined the term asset revesting, because I believe in investing and I believe in big cycles and big movements, but I also believe in you need to reinvest your capital into assets that are moving up. So I don't believe in holding anything going sideways or going down. I'd rather take that capital and move it to a different asset. And, a lot of people don't realize there's a lot of different assets, and you don't really want to be diversified when it comes to the stock market, you don't want to be diversified among many sectors. The stock market is just one asset. So it doesn't matter if you own 30 sector ETFs and a whole bunch of stocks. When the stock market goes down, it's just like the ocean. When the tide goes down, pretty much all boats go down, and so do stocks. So it doesn't matter how diversified you are, you're still going to suffer. So I believe if the stock market is in a longer term downward cycle, you might as well just exit your equities positions and move to a different asset. Could be precious metals, it could be the dollar, it could be a cash position to earn interest until chaos clears its way. So I believe in holding one core asset at a time for your active investment portfolio and moving around to those different assets as it takes place. So that's kind of my core focus. And I use ETFs because we can move unlimited amounts of capital in and out, and they're slower moving. And I really just focus on a handful of key assets, which is the stock indexes, bonds, precious metals, the dollar, and cash. If you focus on those and just move your money around, you can do very, very well with very few trades. And again, this strategy to a passive investor will look active because we have 5 to 12 repositions a year. There's a certain amount of waves that roll through the market every year. So it'll look active to somebody who does nothing, but to an active trader, they'll be like, well, that's not enough trades to make money. So it's one of those awkward timeframes that is kind of right in the middle of what everybody does. And that, I think, is one of the key reasons why we can do so well, is we can identify these waves rolling through the market. move into that asset, catch it. And when these big, strong waves are moving through, the nice thing about it is we can identify when price action is losing its momentum. And so we can get off that wave as it's losing speed because it's, got that extra strength. And once it starts to diminish, it's very clear that money's leaving that space. So that's what I focus on. And I think the whole precious metal space, we are coming into, I think, a prime time for a massive move in precious metals, like another 3, 5, 10-year rally in gold and silver, which will bleed over to the miners as well. So there's a huge opportunity in this in the space when you look at the market from big cycles.
Yeah, that's really insightful. And I think, for the majority of people, we read the quotes from the Buffetts and the Mungers of the world about, not trying to time the market, but spend time in the market. I know myself, I've tried to trade, before, and it has not gone well. But I think that, you provided some interesting insight there that, you don't want to be spread out across a bunch of different asset classes, like really kind of try to focus on a few core ones. Are there any kind of additional principles or strategies that you find most valuable for, someone who's just getting started, who wants to be a little bit more of an active investor?
Yeah. So, I mean, it really comes down to how you want to manage your money, how much money you have. But, if somebody wants to get involved with a strategy like this, they can, have a strategy that I do kind of deployed for them, like an auto trading strategy. So it just executes in their accounts. I look at this strategy is focused on whatever you'd be trading in the equities market, that capital is what would be traded with or invested with this strategy. And the auto trading makes it simple that anybody can take advantage of this type of thing. When it comes to precious metals, somebody starting out, like I look at precious metals, I don't trade precious metals as a trade to try and make money, to buy and sell it. I accumulate physical. I don't really buy any paper metals. And really when I buy it, I'm just more or less stockpiling it. So I look at it as an insurance plan. I don't have like 50% of my net worth in precious metals. I've got 3-4% of my overall net worth in precious metals, and I slowly just keep building it over time. I just actually bought a lot of precious metals not that long ago, because I want to accumulate. We're getting close to a very big breakout and a multi-year run. And I look at it as an insurance plan. If all hell was to break loose, currencies crumble, the financial system, who knows, the stock market blows up, or who knows what's going to happen. You can't really trust anything anymore. I do want to have some physical currency that I can rely on and be like, okay, I actually own this. It's not just a bunch of zeros and ones disappeared in my accounts or my brokerage and things like that. So I look at it as just slowly keep accumulating it. I'm not really looking to ever cash out, except for way down the road when I'm older or I pass it on to my kids. But I look at it as an insurance plan, it's a diversification play, but insurance in case something really bad happens. Hopefully it will skyrocket in value to counter some losses that I would be, suffering in other places, different assets.
Yeah, and that's a common theme that comes up on the show quite often. Mark has talked about it, a few of our other guests as well. When it comes to metals, that's what you want to be doing. You want to be stockpiling the actual physical metals themselves. You don't want to be trading them, nearly as much as you would trade any other asset classes. Maybe, buy a little heavy on silver so that you can trade into some more gold later on. But that's really kind of the extent that you want to be doing it. I want to ask just, we're going to get into this metals conversation really quickly here, but when it comes to managing risk, what other, advice do you have for traders looking to improve their risk management skills when it comes to trading?
Yeah, it's a tough one. I mean, the key here is I've as a teenager, I've gone through a bankruptcy. My parents had gone through a bankruptcy. So I've experienced having a very good lifestyle, top of the food chain. My parents were retired, ended up having a major problem. They went bankrupt. So we went to the bottom of the food chain with nothing but literally our clothes and our furniture. So I have gone from the top to the bottom and back to the top again. And so I learned that at a very young age that I was going to protect my capital at all costs. I would rather grow at a slower rate and be really wealthy and compound and not stress about money, than go through the roller coaster and never know where I'm going to be 5-10 years from now. I also got my POTS license when I was 16 years old. And that really taught me about systems, about strategies, about having rules in place. And I remember when I did my solo flight, I took off and I was the most emotional kid ever. I was singing, I was like laughing, I was crying. I could not believe I was flying on my own. And before I know it, I'm like, okay, I have to get into a routine here. I got to do the circuit to not only pass the test, but I have to land without crashing and burning. And I remember touching down and taxiing off, and my instructor's like, Chris, congratulations, you're a pilot. And I remember the only thing that got me down, because my emotions took over, which is what happens to most traders and traders and investors, is their emotions run wild and it makes them do crazy things with their money, was a checklist. I had done, gone through this checklist 1,000 times. There's a system in place. You put the flaps down, you do everything, you make your radio calls. And if you follow the system, doesn't matter how chaotic things are around you, you have a very good chance of landing on your wheels. And that's what I do with trading. I carried that right away into trading. As soon as I learned about the whole power of systemizing things, I started creating strategies to pick stocks out of the newspaper. This was back when all the tickers were in the back of the newspapers, and you start creating rules. And so everybody you need to have a strategy. If you don't have any strategy, you're just shooting by the hip and buying here and there and selling here and there. It might work out for 5, 10, 15 years. You might have a good spell, but eventually it'll catch up and you do the wrong thing at the wrong time, or you don't do anything and you get caught in a massive stage 4, a massive collapse in the markets. And you give back all of that, what you thought was a strategy, it really isn't. You give back all those gains. And so everything I do is systemized. There's rules, reasons, lots of analysis, and I really try and funnel out the news. I mean, I haven't listened to news, or I don't have cable or anything like that for 10 plus years. So getting Mark's update there on what's going on, that is my first piece of news. Usually my kids who are 11 and 13 tell me when something extreme is happening. But I mean, I love not having to focus on the news because it's always negative. And I just focus on the price and I follow price. I don't have to pick a bottom. I don't have to try and pick a top. I identify strong trends. We move in. And when those trends are fading, we start to scale out. And that's how I kind of go about managing risk.
That's fascinating. That kind of negates my next question, because I was going to start to get into the markets a little bit here and just ask you, what your thoughts are for 2024 based on everything we're seeing right now. We're seeing, inflation. We're seeing interest rates being high, but it appears as though you're not focused on that. You're looking at the numbers at the end of the day. But let's start with the broader markets and then kind of dig down into the metals. What are you looking at in 2024? What are your thoughts moving forward? We just saw the S&P 500 hit, new all-time highs. Is this sustainable? Some people are calling for correction. Others are calling for straight out like recession. What do you think we're headed for in the markets in 2024?
Yeah, I think when we look at the stock market and the economy they're both on their own cycle. They both turn at different times. I believe the stock market is in a major topping phase. We've seen this particular type of setup in the stock market happen in 2008. We saw the stock market poke to just a new nominal high, and it really sucked in all the last investors who weren't in the market. So for example, when the market hits a new all-time high like it just hit, a lot of people were betting on a big sell-off. Yet now they have to cover their shorts, meaning buy back their bets against the market because it's hitting new all-time highs. The trend is up. They're literally on the wrong side. So we saw a strong pop during the breakout of a lot of people covering their shorts, which creates a buying wave. And then also, now that we got it in the news that we're hitting new all-time highs, we're seeing the general public who missed out on all of last year's gains, who aren't in the market. They're going, crap, like they have FOMO. They're like, I have to get in. We're at new highs and I can't miss out. Everybody else is on this. So this is what the market, I believe, is doing, is sucking everybody in. The shorts are now out. The last of the last people who are going to get in are getting in. And then the market is going to tank like 30, 50%, which is what happened in 2008. So I believe this year is going to be a very difficult year for the equities markets. Gold tends to hold up as one of the best assets that holds up. It'll still be under some pressure, but overall it holds up very well. As we know, it's been poking to nominal new highs for the last month and a half or so. And that's versus silver, which is down like 50+%. Gold miners are down 50+%. And that's simply because gold is a global reserve currency. It's the first thing that comes to the average investor's mind. If I can't own stocks or bonds, what am I going to buy? And they'd be like gold or gold coins, anything like that, right? And that's why it's holding up there, is because it is getting just that natural inflow of people buying into it. And the nice thing I like about gold is it's slow moving. A lot of people don't want things that move slow. Well, one of the reasons why I think gold is much more of a safe investment and why it's holding up is because you can put a lot of money into it and not worry about it losing 20% in one day. It is a slow beast. A big day on gold is like a percent and a half generally. And that's a pretty big day for gold. So the slower something moves, the more capital can be comfortable, in it. So that's kind of where I think this year's a difficult year for equities. I think gold is probably going to tread higher, maybe squeeze up a little bit until the stock market really puts in a top. And then all that selling pressure might, pull gold down a little bit. But overall, gold and precious metals will be one of the first kind of commodities to bottom, probably months before the stock market, and then take off to what I think will be some pretty exciting pricing.
Yeah, it's been an interesting, first couple of weeks to the new year, because obviously everyone was riding a high. Gold hit new all-time highs of $2,180 around there, and everyone was headed into the new year very, very bullish, and we were expecting interest rate cuts and whatnot, and that, as Mark mentioned, seems to be kind of on the brink of not happening anymore. We're unsure what the Fed will do. I know you talk about a super cycle in the precious metal space. Let's maybe start with gold. Maybe you can explain the concept of a super cycle and what that means for investors.
Yeah, so a super cycle is just a huge cycle that happens in the kind of the whole world, that really where commodities or certain assets become way overvalued and other ones become way undervalued compared to each other. If you go back to like 2000, 2001, we saw the beginning of the last super cycle, meaning commodities were the most undervalued asset out there compared to real estate, compared to stocks. And then we went into this massive, pretty much a 10-year bull market for gold. And it went from, 200 and change up to a couple $1,000s. So it was a very big run. This super cycle really is just started in 2019. So we're already on the up and up within this cycle. And it's the same type of scenario. We saw precious metals, we saw gold, commodities in general be the most undervalued they had been compared to other asset classes since the 2001 start of the gold rally. So these are huge cycles where we've just seen in the 2000 tech bubble. It was also, there was a lot of housing pricing going up, but we're seeing the same type of thing happen right now. Everybody's piling into technology. They piled into growth stocks. Real estate is like nosebleed pricing. Everything is really overvalued. Everybody's now gouging. I mean, we're just in a really lofty, high risk environment, I think, to put on new investments in businesses, in stocks. I think all those carry a ton of risk. And all that needs to unwind. We need to see a big correction in real estate, a big correction in stocks. And that is going to send a lot of people back to, alternate assets, which is where gold comes in for the general public as the alternate kind of place to put some money. And when you look at how many people actually hold gold, Peter Schiff said it a while ago. I don't remember what the number is, but it's something like the average investor globally only has like a third of their account, not a third of a percent of their portfolio in gold. So a tiny, tiny little bit. And back during the big boom in 2011, it was something like 3.5% of the average investor had it. So we have got like room to 10x people wanting to pile into gold to get back to what it was. So it is very undervalued. Nobody's really holding it in their portfolios, the general public, that is. And they're the ones who create that feeding frenzy and that huge, never-ending month after month rally. So there's a lot of exciting things coming together for gold going forward, and that cycle takes years to unfold. My crypto has taken a lot of energy and money out of the precious metal space, but we are seeing gold hit new highs. Cryptos are struggling, so I think we're going to start to see a shift of people saying, "Well, I want to get back into metals." Because it is hitting new highs and it's trending up. And so, yeah, it takes a long time for these shifts to occur. It takes years. And that's a nice thing. I like big, slow moving assets that have, major cycles and movement behind them that can last a long time.
Very interesting. Thank you for that, Chris. So we've talked, predominantly about gold. You mentioned silver just a moment ago. Silver investors, they keep stockpiling silver. As you said, it's down 50-60% from all-time highs, and everyone's kind of just waiting for this big squeeze in silver to get back to those all-time highs, where gold is only down 5 or 6% from the all-time high it set in December. What's it going to be that pushes silver over that line and sends it on a rally? Is it in the same sort of super cycle as gold is?
It is. It's in the same cycle. They generally move together, but when people are getting rid of risk and they're nervous, silver is kind of one of those that sells off. It definitely has a lot more aggressive traders in it, speculative traders, which that group of people are, for lack of terms, a little more emotional. They buy it and they sell it. They're just more active. Whereas people who buy gold kind of set it and forget it, right? They buy it and they set it aside and they just let it stay shiny for decades. So when there's a little bit of pressure, we see silver quickly deflate. I think when we see the masses start to move into precious metals, which I think that big cycle hopefully will start late this year, because I do think we're going to see sell-off in the stock market. It means gold and silver will probably trade sideways or slightly lower. It'll really just pause. But once that selling has kind of worked itself out of the system, the money is going to start to flow, and that's when silver can play catch up. And as we know, it just goes parabolic, and people wait for that move in silver like literally 10 years every time. So people have been waiting for this forever, and we're getting close, I think, to it. And I think we're going to see, $50 or $80 silver, but we gotta just let this market work itself out. And we're going to see some type of correction in the economy, in the stock market, which will pull metals down a little bit. To me, it'll be the last key buying opportunity for gold and silver. I'm hoping that we see the stock market crash. I hope we see actually gold and silver pull back, because it's kind of, to me, based on everything and previous price patterns and all that's coming together, it's that last one opportunity to load up with bars at one last kind of fair discounted value, and then watch it take off for 3 or 5 years or plus after that. So everybody's got some people just want to keep going up. I want it to pull back because I want to do one last purchase,
Right.
big purchase, but everybody's got their own strategies and mindsets.
So then with that in mind, you're saying that a pullback, a collapse in the stock market is a possibility, and I don't want you to give away too much of your secret sauce here, but how do people position themselves for that sort of scenario?
Yeah, so I mean, I use a lot of different type of data and analysis that goes into things. So the average technical trader will use a bunch of indicators, which all use the same data that's on the chart. They take the price that's on the chart, and there's thousands of ways to spit it out with different indicators. The way I go about doing things is, as you guys know, the market it's interwoven. Everything is connected in some way. If one asset is rocketing higher, another one is probably crashing. Money is usually flowing, in and out of different assets and rotating. And so I look at a lot of different stuff. First, I look at price, the technicals. I like to look at price action. I apply analysis to it. Are we trending up on the long term? Are we trending down? On the intermediate term, what's the trend direction? Short term, you put all those together so we can follow price and say, okay, we are in a strong uptrend in a long-term super cycle. That gives us a bias of which direction to be. I like to look at, what are the different asset classes doing? What's gold doing relative to the stock market? What are utilities doing? What are currencies doing? What are, a lot of different assets and when we can see where money's flowing into certain ones or out of those, it tells us how much people are committing, or how brave they are, or how scared they are in the market. And it gives us insight to whether a rally has got legs behind it, or if it's actually starting to break down behind the scenes. I also look at what the New York Stock Exchange volume flows are doing, which is an amazing tool for short-term analysis to identify when people have FOMO and there's just a surge of short covering and people are just, they have to get in, they feel like they're missing out, or when they're short-term panic selling. All these things come together. And if you weave them together and apply them, I also put in cycle analysis, because there's time cycles, there's economic data that rolls out monthly, quarterly, all those things, and people's paychecks naturally go into the stock market every week or bi-weekly or every month. So there's all kinds of these cycles and movements. And when you weave it all together, you can say, okay, we got all these things lining up. They continue to strengthen. We should be long, precious metals. Or they're starting to weaken. We could be like, okay, I expect, we're going to see some type of continuation of this pause. We're going to chop sideways for maybe another 3 or 4 or 5 months. So that's what we use. We use all those things, and that really guides us to tell us, what is the big money doing? And then also, what are the masses doing with their money? They're two very different groups, but when they're both in the same direction, the money flows are the same. That's when you get these powerful waves that can last a long time.
Awesome. Thank you for that, Chris. Appreciate it. This has been a really insightful interview, and I definitely think we're going to pick this up again in a couple of months. Have you back on if you're up to that, and we'll see how your thesis has evolved over the course of the year. Before we leave you, I just want to give you an opportunity to let the audience know where they can follow you, how they can subscribe to the Technical Traders. Let us know how do we learn more.
Sure. Yeah. Well, I'd love to be back on the show. It's always a pleasure sharing gold analysis. But yeah, if people like what I'm sharing here and it makes sense, they can go to my website, which is thetechnicaltraders.com. And more or less, I share my screen every day. If you want to, you can follow along. I teach analysis. We put on ETF trades. I trade my own capital. So you're more or less following what I do. I don't just give out trades. I only give out things that I'm doing. And I focus on following all the precious metals and the indexes and all that every week. And I have, an auto trading service, which I don't charge anything extra. So if somebody doesn't want to learn, they don't want to follow the markets every day, they just want to have their money growing on the upside, only holding assets rising, or we're sitting in cash collecting interest, then they can have an auto trading activated to execute in their account. So it's pretty straightforward. My book, Asset Revesting, is at Amazon or all the different stores. It really breaks down kind of what we kind of touched on a high level today, the asset hierarchy of how we protect our capital, what assets we rotate to one at a time, the reasons why we do that. So, yeah.
Awesome. Thank you very much for that, Chris. Appreciate it. Appreciate your time. Thank you for being on the show, and we'll definitely get you back soon.
Thanks, Jeremy.
All right. As always, we like to close the show with a segment we call Bullion Basics by Mark Yaxley. Mark, what can you teach us today?
Yeah, first of all, I just want to say thanks to Chris. I actually went out and ordered his book on Amazon as you two were conducting the interview. So I'm definitely interested in learning more about Chris's methodology, and looking forward to receiving that delivery. So this week's Bullion Basics, I think a good time to talk about the gold-silver ratio. Now, this is not an indicator that I've paid a particular amount of attention to over my career, but at times the gold-silver ratio can become very relevant to investors, and I actually think now is one of those moments. So for those of you who are not familiar with the gold-silver ratio, what it does is it measures the value of 1 ounce of gold versus the value of 1 ounce of silver. With gold trading today at about 25 price in US dollars, and silver closer to 22.50 an ounce, the current gold-silver ratio is about 91. So meaning you could buy 91 ounces of silver for every 1 ounce of gold. And why is that relevant, Jeremy? It's because the ratio is significantly higher right now than its historical norm. To give you some context, back in the 60s, when analysts really started to track the gold-silver ratio, it was about 20-1 at the time. The historical norm is somewhere around 70-1, and in the past 12 months, the average gold-silver ratio was 82-1 or 82, which means the current gold-silver ratio is about 25% higher than the historical norm and a good 10% higher than this past year's average. So what that tells us, or at least indicates, is that silver is undervalued relative to gold at the moment. You could say approximately 10% undervalued, maybe more. Chris pointed out earlier that silver's 50-60% off that all-time high, and he, I think, mentioned a price possibly of up to $80 an ounce. So again, I think we're getting an expert that's seeing more or less the same thing. So as an investor, if you're deciding on whether to invest next in gold or silver, or potentially you already own a large gold position and you're thinking about swapping some of those gold ounces into silver ounces, this indicator, the gold silver ratio, is telling us that this is a good time to be considering that silver trade. And interesting to note, Jeremy, the all-time high for the gold silver ratio was 126 back in April of 2020 when COVID reared its ugly head and threw the global economy into a big mess. But again, at 91, it's still relatively high. There might be a little bit more to go there, but I think investors should be thinking about silver right now, personally.
Awesome. Thank you, Mark. That is all for us today. Thank you to everyone for watching and to ANCAP Radio for partnering with us. And lastly, to our guest, Chris Vermeulen, for joining us. Head on over to the Strategic Wealth Preservation YouTube channel for loads of educational content. And don't forget to like and subscribe when you're there. If you're interested in learning more about precious metals investing, send us an email to info@swpcayman.com and a member of our team will assist you. Until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.